What do returns look like in a multifamily syndication? I'm Seth Ferguson. I'm the COO of CPI Capital, a real estate investment firm that focuses on multifamily properties. And in this video, I'm going to be breaking down the actual returns of a real deal. This is a deal we closed on last year. I'll be breaking down the exact returns to expect. So if you're looking at possibly investing in your first syndication or you're a seasoned investor, just you can get a handle on exactly what the real returns look like from a real deal and what to expect. So let's take a look. I've broken down everything on slides to keep it nice and easy. And this is a question we get all the time from people. What do these returns look like? So this particular deal, it's 136 units. We're looking at a $100,000 investment, and the IRR, the internal rate of return, I'll get to that in just a little bit, is about 17.36%. So when we start looking at multifamily syndication deals, it's first important to understand, well, what is a syndication? So a syndication is a type of investment structure that's used to pool investor capital, passive investors who have capital that they want to invest in an apartment building in multifamily syndication. And then you have the other side, which is the sponsor, the general partnership, and that's in this case, us. We're the real estate professionals. We've got the team, the track record, the experience. So when you put these two groups together, it's called a syndication, and there's a lot of benefits in terms of protections for the LPs. You get tax benefits through it. There's a lot of good that comes out of using the syndication structure. So let's get started with year one. So a $100,000 investment, 136 unit deal, and this is a value add deal. So what value add means is we're basically acquiring a property that's not performing to market standard. So here's the market standard here. It's not performing where it should be. So we come in and do our work. So this for this particular deal, it involves doing some interior renovations, exterior renovations. We're changing the facade on the front, doing a bunch of landscaping, some amenities in there, but also improving the rents, raising the rents, and improving management of the property. So really, we have two value levers that we can pull, which is physical improvements, the renos, and then we have operational efficiencies, which is how we actually manage the property. So our company comes in, implements our procedures, our processes, and we can basically do a better job managing the existing property. And when we do that, we create value or money and returns for our investors. So let's take a look at year one. So you've invested $100,000 in this deal. And in year one, the projection was a cash on cash return of 4.7%. So that means you get a check every month from us. And over the year, that adds up to $4,700. So that's your total return in year one. Now, when we fast forward to year two, because what's happening is we're implementing our business plan. So the first year we acquired the property, we're doing a lot of work. We're doing the renovations, starting to implement our management procedures and our systems. In year two, that continues, but you're seeing we're improving the cash on cash return because now the property is cash flowing more. We're raising the rents. We're doing all of that work. So this is really, think of it as a multi-year flip of, everybody knows flipping for houses. Think of this as a larger scale, 136 unit flip over multiple years. So in year two, cash on cash return goes up to 7.1%. So that's $7,100 in terms of hard cash that's returned to you as the investor. And we do these distributions. Now, with distributions, I should mention that there's really two ways of making money as a passive investor in a multifamily syndication. So on the one side, you have cash flow distributions, which is all of the free cash flow from the property that's paid out to the investors. So you get monthly checks most often. Sometimes people will do quarterly checks. So you get those in your mailbox every single month. So that's the cash flow, the free cash flow. Now, there is something called a capital event. So this is where we sell the property. We're going to get to that in just a little bit and the impact that has on the returns. And there's also refinance. That's a capital event. So the way I like to think of this is the cash flow distributions, that's like the cookie crumbs that keep you hungry and satisfied. And then you get the big cake, the big treat at the end when you either sell or you refinance. We'll see the impact on the returns that has when we go to sell this property. So in year 3, we've got 8.3% for the cash on cash return. And then so that's $8,300. Year 4, 9.5%. So $9,500. So we can see the big impact that us owning the property, managing it our way, us doing the renovations, raising the rents, doing the tweaks that we do with our value add creation system. You can see the impact this has on the deal year after year after year. And this is really what we're focusing on. We're really looking at coming in, creating value, making a better experience for the tenants, doing those improvements, adding, whether it's a swimming pool or the gym, a business center, a dog park, to make the tenants, to make their experience better, give them what they're demanding and what they want, but also adding the efficiencies and just hitting the market with a better product. This is what it's all about. So in year 5, I mentioned the cake, the capital events. This is when we're selling. So we've got the cash on cash return of 9.8%. So that's $9,700 coming in from the free cash flow distributions. But then we also see something in the return from disposition. Disposition is a fancy word. It's a fancy way of saying, hey, we're selling the property now. So after the commissions and all the costs of that go into selling a property, this investor with a $100,000 investment is going to be receiving $165,500 from disposition. So that's on top of the cash on cash, the annual dispositions that get paid out. So what happens is over the 5 years, because with this deal, this is a 5-year hold that we're looking at. Every year 1 to year 5, you get those monthly checks, those cash flow distributions, the free cash flow that gets paid out. But at the end, when we're ready to sell, so we've already implemented our business plan, we've forced that value, we've done a lot of the work. Now it's time to sell it to a buyer who doesn't want to do the work. They just want to sit, park some money. There's so many different end users, buyers for these types of properties. So now we're looking to sell, and from the sale proceeds, this investor investing $100,000 is going to be receiving $165,500 just from the disposition proceeds. So in year 5, they're really getting $175,500 in cash flow. So what that looks like for totals, the total cash flow over the 5-year hold is $39,500. So that's money delivered by check in your bank account just because you've invested in the syndication. And then the return from disposition, like I said, $165,500. That's that one-time check you get when a capital event happens. So the total return, you can see over the 5 years, is $205,000 and then $197 on top of that. But $205,000 is returned with a $100,000 investment. Now, there's different ways of measuring the return on your investment in a deal like this. So I've already mentioned IRR, but I want to touch on the different ways, the different numbers you're going to see and what they mean. So IRR, that means your internal rate of return. So when I mentioned the cash on cash return that we're seeing at the top here, year 1, 2, 3, 4, that 4.5, or is 4.7, 7.1. That's cash on cash. So that's a measurement of how much money have you invested and what is your return in that year, that annual period. That's cash on cash. But what cash on cash doesn't do is it doesn't give you the time value of money in that equation. So what internal rate of return does is it measures, how much money you're receiving over the lifetime of your investment, but it also weights how long your capital is in that deal, right? So with your cash on cash annualized, we're looking at 21.04% over the return of the deal, the lifetime of the deal, but your IRR is 17.36%. Now, there's also something called your equity multiple. So in plain speak, it's, well, how much is my money growing? So you're going to see we have a $205,000 that's being returned to the investor. These are the returns. So we're basically 2.05xing your money. We're doubling your money, right? Because you invested $100,000, you're getting $200,000 back. That's doubling your money. So the equity multiple is a really easy way of saying, hey, well, how much money am I getting back? Am I doubling my money, which would be a 2x? In this case, it's a little bit better than a 2x. If it's a 1.5x, you're getting a 50% return on your money. It's a really easy way, a clean metric to use just to see what your money is doing in the deal. So we've walked through year 1 all the way through year 5. And this is a very good example of a value add multifamily syndication type of deal. You've got a 2x on your money, a very healthy IRR of 17.36%. Now, what I haven't mentioned yet are the tax benefits that come along with investing in a multifamily syndication like this. Because as Robert Kiyosaki says, it's not what you make, it's what you keep. So on the surface, we've got great returns, but this is what our investors do. They're able to take these returns, but then offset a lot of these profits using what's called cost segregation. So we do cost segregation studies on our properties. And what this does is it front loads depreciation, meaning that you can actually incur these paper losses in year 1 and really minimize your tax liability. This is what a lot of sophisticated investors do. Our investors really enjoy those benefits of investing multifamily syndications with us, because that allows them to basically keep more hard-earned dollars in their pockets, and then they can use that to invest in another opportunity, move that to a different venture. There's a lot of different things you can do with that money once you keep it in your pocket and you're not giving it to Uncle Sam. So if you are interested in learning more about how you can invest in deals like this one, just like this one, because we just closed on this one last year, go to sethferguson.org/invest, sethferguson.org/invest. You can book a call with my team, learn more about how we run our deals, the types of deals we're working on, what the returns look like, what to expect, how these are paid out, all of those types of questions. But yeah, if you're looking for a passive investment opportunity just like this, where you're not dealing with the headaches, you're basically writing the check. Our team does all the heavy lifting, and we're sending you that mailbox money every month. Just go to sethferguson.org/invest. So I hope this was helpful. I hope this gave you a really good idea on what to expect, what the returns actually look like in a real multifamily deal. So check that out, and I'll see you guys next week.